From 529s and 401ks to NFTs and ETFs, financial information might seem to be a tangle of letters and numbers, which can be intimidating for a novice investor. To take the initial steps towards investing, you don't need a financial degree. I'm a money geek, Barros explains, so I delve into the weeds about this stuff. However, you don't have to be this geeky to be a great investor and develop money. So where do you begin? Check out our glossary of financial terms to learn more about them and to get started on the path to generating wealth. We've put together a list of 10 financial terms that every new investor should be aware of in this video. Welcome to the YouTube channel, and please remember to like, share, and subscribe to the channel before we begin the video. Number 10. 401k and 403b plans. All of these numbers and letters are just abbreviations for retirement accounts, into which you may deposit a portion of your earnings via your workplace. A contribution to either kind of account is limited to $19,500 per year, with those over 50 years of age being able to make an extra $6,500 per year. Tax-deferred growth continues until you're ready to take it out, also known as take distributions for retirement, or until you're in need of borrowing or withdrawing money due to financial hardship such as a job loss or illness, though you may be subject to penalties on your withdrawal, depending on the reason for your withdrawal. What is the most significant distinction between 401ks and 403bs? 401k plans are used by the majority of private enterprises, while 403b plans are used by nonprofit organizations, schools, and government agencies. 401k plans often include a corporate match, which means that your employer will contribute money to match a part of the money you contribute. 403bs, on the other hand, have additional perks, such as decreased costs. Number 9. IRAs, SEP IRAs, Roth IRAs, and simple IRAs. A personal retirement account (IRA) is a savings account that you may use to put money down for your own retirement. Traditional IRAs, SEP IRAs, and simple IRAs are the three varieties of IRAs that enable you to deduct the money you put into your IRA from your taxable income. SEP IRAs are retirement funds designed specifically for self-employed people. Simple IRAs are retirement accounts that are often utilized by small organizations with less than 100 workers to assist in the funding of their employees' retirement plans. Roth IRAs, on the other hand, do not now provide tax advantages, but the money you earn from your investments may be taken tax-free when you reach the age of retirement. Number 8. Mutual funds, target date funds, and exchange-traded funds (ETFs). Mutual funds are an excellent method to invest in a variety of different firms, at the same time allowing you to build a broader portfolio of assets. Regardless of how much money you have to invest, if you acquire a share of a mutual fund, you will get a portion of the profits from each of the investments that the mutual fund has made. It is possible to discover mutual funds that specialize in certain sorts of investments. For example, just tech stocks, socially conscious business, or dividend-paying stocks, as well as index funds that cover either the whole stock market or only the top 500 firms. Target date funds are a simple approach to investing that allows you to set it and forget it. In essence, a target date fund is a super fund that invests in both equities and bonds. According to Barros, as you get older, it immediately becomes more balanced for you. As you become older, your portfolio will shift from an aggressive to a somewhat aggressive approach, and finally to a more cautious one, allowing you to perceive the wealth that you've accumulated. Investing in exchange-traded funds (ETFs) is similar to investing in mutual funds, in that they enable you to purchase shares in a bigger pool of firms in a single, lower-price share. A large number of these are based on simple groups, such as the whole stock market or the firms in the S&P 500. You will often pay lower management fees for these than you would for mutual funds. Number 7. Cash flow management. We refer to it as budgeting, but the affluent refer to it as cash flow management. Barros explains, essentially cash flow management is the process of monitoring and regulating the movement of money into and out of your business. Number 6. Dividend. A dividend is a percentage of a company's income that is distributed to its shareholders on a quarterly basis. The amount of money that is given out changes based on how well the firm does. Number 5. cryptocurrency, Bitcoin, blockchain, and NFTs. There's a lot of excitement about these new investment conditions right now. Coins and digital currency systems that are not related to or regulated by any government made it simple to transfer money from one account to another without the need for intermediaries like banks or other financial institutions. Bitcoin and Ethereum are the most well-known and widely used cryptocurrencies at the moment, but there are a plethora of others to choose from as well. Cryptocurrencies are maintained on a blockchain, which is kind of a database in order to establish a safe record of every transaction done. It keeps track of Bitcoin transactions. The data is kept in smaller bits, referred to as blocks. They are linked together to create a blockchain of information. NFTs, non-fungible tokens, are another kind of token that may be discovered on the blockchain. In many cases, they are original digital works that cannot be duplicated. For example, artwork, meme images have been a popular NFT. NFTs, on the other hand, may be purchased and sold, although at inflated rates. Number 4. 5 to 9 plan. In the event that you have children or want to have children, a 5 to 9 plan is an excellent approach to save money for your child's college education. The money you put into it, as well as any profits you make on your investment, may be used to pay for educational expenditures, such as K-12 private schooling, books, college tuition, and room and board, and other fees without incurring any tax consequences. Number 3. P/E ratio. The price-to-earning ratio, also known as the price-to-book ratio, gauges how the price of a share is related to the amount of money a firm makes per share. If the price of a company's stock is high in relation to its profits, the stock may be inflated and a little expensive in comparison to what you would get. Number 2. Bonds. Bonds are financial instruments that enable you to lend your money to a firm or the government in return for a fixed rate of interest. The amount of return you get on your investment, as well as how hazardous the investment is entirely dependent on who you lend the money to and how creditworthy they are. You may also invest in bond funds, which are similar to mutual funds in that they invest in bonds. They provide you the opportunity to invest in a variety of various bonds. Number 1. Compound interest. Compound interest is interest earned on money you have deposited or borrowed in addition to the principal amount. When you invest or save, compound interest is generated on the amount you deposit, as well as any interest that has accrued over the course of the investment or saving period. When you borrow money, however, you will be charged compound interest on both the initial amount of the loan as well as any interest charges that are added to your outstanding debt over time. That concludes today's video. We hope you liked it. Feel free to let us know in the comments area on which topic we should make a video. Thank you for watching, and don't forget to like, share, and subscribe to the channel.